What's going on, you guys, and welcome back to the channel. If it's your first time here, my name is Brandon. As always, we do have our Investing Academy, which is that first link down below. But today's video, I've been looking forward to filming all day long. Really, it's been for the past couple of days that I've been compiling up my research, because today we are going over 5 stocks to own in 2020 for the month and a bit that's left, and on to 2021. And the reality is, as a long-term investor, we should all be looking to own these stocks much longer than that. But that's more or less the title that we're running with. And what I love about the selection I have for you guys today, they are so diverse in the sense that we have growth stocks, we have dividend stocks, we have Canadian stocks, we have US stocks. Everyone should be able to find a pick here that they like. And I really hope by showing the different types of companies I look for, these are all companies that I'm big fans of, that will actually give you guys some insights into the things you can aim for, the types of ways you can view certain stocks and how they compile up into a portfolio. With all that said, let's dive on in. All I ask is that if you do enjoy this, it took a lot of research for this one because we're going over 5 instead of 3 or 2. All I ask is that you give this video a thumbs up, and I really hope you guys enjoy. Let's start off with a company that we haven't touched on in over a year on the channel. It's the company Activision Blizzard, ticker ATVI. I'm curious how many of you have been supporting the channel since then, because Activision Blizzard was, if you can recall, one of my top picks back in the day. The stock had dropped 45%, in my opinion, a little bit unjustifiably. And since then, they have been on fire. This recent quarter, this is the September 2020 numbers that they just posted. What an earnings report. To just look at the green across the board. Revenues up 52% year over year. Net income up nearly 200%. Earnings per share as well, diluted up 200%. Just overall a very strong quarter. And if you are, for the first time, hearing about the company Activision Blizzard, just as a quick background, this is one of the world's largest video game companies out there. They're best known for franchises like the Call of Duty franchise, World of Warcraft, Diablo, Overwatch, even Candy Crush on the mobile platforms. It's not just the console games or computer games, but to me, this stock and Tencent, if you actually look into some of the names that they own, if you complement these two stocks up together, that is a deadly grasp on the video game industry, at least in my opinion. I personally believe that the esports space, the video game space, is one of the most underrated areas of the market in terms of growth and in terms of the potential that it has going forward. Esports, just to look at some of the revenue numbers, this is just in general, globally, we see in 2020 actually was the first year that we passed over $1 billion in revenue, up 15% over the previous year. Projecting out into 2023, they see this number growing to 1.5 billion. Taking it a step further, to break down the revenue streams, you see sponsorships, media rights, merchandise and tickets, obviously publisher fees, streaming, etc., etc. But what I think is the takeaway, or what needs to be understood about this video games sector at the moment, is that it is legitimately becoming a form of entertainment. From Twitch to YouTube streamers to the events that you can literally go attend worldwide. Take a League of Legends Worlds. I mean, obviously it's a bit different with COVID right now, but these events literally pack arenas worldwide. I'm sure the younger audience for the channel is quite familiar with this, but I know a lot of our older viewers will be surprised to hear that. Literally sold out Staples Centers, sold out arenas to watch people play video games. I think I saw a statistic one time, which I'll have to dig up, and hopefully I can pop it up on the screen for you guys here. I believe that the League of Legends finals, like the tournament finals game or the finals match, had a higher viewership than the NBA finals, which is just, it's crazy when you think about it that way. But what that shows me, and what that dictates, or what it should at least, is that this is a legitimate form of entertainment. It's a legitimate form of eyes and viewers. And when you look at that from an advertising standpoint, if you are a big company, which we are already seeing, we're seeing so many sponsorships with legitimate companies out there. If esports and video games has the power to retain all these viewers, advertisers, or companies I should say, are gonna pump their advertising dollars here. They're gonna put their products in front of the faces. It really is promising to see the amount of viewership and the amount of traffic that this space is generating in in its entirety. And I believe that we're kind of just at the forefront, believe it or not. To take a look into some specific metrics with Activision Blizzard, I have highlighted here in red their net earnings line, the bottom line over the past 5 or so years. We've seen this tailwind really help the company out. They've gone from $835 million in 2014 to where we stand today, up to $2.2 billion. Earnings per share has grown as well with that. And by taking a look at the valuation metrics, now that the company is earning money, now that the bottom line is growing, we see a significantly lower price to earnings ratio relative to its 5-year average. This is something that we love to see, especially given that if you were following along with the company last year, they were going through a bit of a rough patch with layoffs, and the gaming community was not so happy. There was a little bit of turmoil going on, but again, looking at that recent quarter, it really seems like they've turned a corner. And I had no question that they would, again, with some of the key names that they have under their belt. The thing about video games is that they kind of come and go in phases, but if you own a big franchise like this, I mean, the sales of them will obviously be quite sporadic, but as long as you have a powerhouse name like the Call of Duty franchise, just for example, people will keep coming and buying the new games. What I think is a very promising point in today's environment, if you want to get into it, is that the video game sector could actually benefit from another lockdown. I know we're seeing cases spike up all over the world. Here in Vancouver, we're seeing record level cases. If we do shut down again, it's a simple fact that I think more people will be playing video games. I think more people will be streaming, and companies very well may pour more advertising dollars into these games. I was just watching a tournament on Twitch over the past weekend, $300,000 in prize pool money. It's a legitimate space where they're growing, they're evolving, and I think it's an area that you definitely want to be in. The stock obviously has done quite well, and it's one that I would throw more or less on the watch list. I think it's fairly valued at this point, but if this stock does drop off, it'd be a great one to add over the next little while or even into 2021. But the first stock is the company Activision Blizzard. Moving on to stock number 2, which is in a way an opposite of that, because I believe it is a good purchase at the moment, and we are shifting over to the Canadian market. It's the company Brookfield Asset Management, ticker BAM.A.TO. And by Morningstar's valuation, as we looked at in the last video, I know a lot of you guys enjoyed this. They've got a fair value estimate, or they've got a target set at $57, whereas the stock today trades at $48, representing a 15% upside. And Brookfield has dropped, they're down about 20% since the peak back in February. This is pre-COVID, of course. COVID really played a big impact on this company. If you're not familiar with Brookfield Asset Management, they are quite a complex business in the sense that they manage a lot of money. A simple way that I would kind of like to categorize this company is they're an asset manager in the sense that they manage real estate, they manage renewable energies, they manage private equity, really a wide variety of areas. But in general, just to hear the size of this company, they manage, or their assets under management are $575 billion across the globe. So a very, very serious company, and they are based and headquartered out of Toronto, I believe it is. The company itself credits the drop in share price and the recent struggles. Really, a lot of it has been pinpointed on COVID. You see that about 10 to 20% of their businesses across the board have been hampered. Areas in particular they cite here are the short-term private equity area, hospitality, retail malls, obviously toll roads. To me, to keep this analysis a little bit shorter, because we have done videos on BAM, I'm sure you guys are pretty sick and tired of me hearing, you guys are sick and tired of me talking about BAM. You can go search up some more stocks on the channel if you are. To me, this is one of the premier options for stocks here in Canada. They're an extremely well-run business. They have a great track record. And one thing that I really like about Brookfield Asset Management is the management team themselves. They're very transparent and they're very clear about the direction of the company. And they really make, at least the way I interpret it, as a shareholder, they really make you feel like they're in it for the company's best interest, not just the stock manipulation, not just about the share price today or next month or next quarter. They really seem to have the company's appreciation over the long term at the heart of what they do. And that to me is displayed through the shareholder letters, through the way they release their newsletters, and just the way, I mean, if you look on there, for example, their investor relations page, if you keep up with the company, as complex as a company it is, they do, in my opinion, a very good job of managing the company. Don't get me wrong, it's not to glaze over and neglect that the fact that the company is going through a tough time right now. There's no question about that. in particular certain areas like the real estate they manage, like retail malls, which hopefully can be getting back to normal soon. I'm not necessarily saying that's the case, but more or less, if we do have a long-term outlook, company has been through it before in the past. They have a great track record of success, and I like to believe that they'll be able to get through this going forward. So to me, this dip is a chance to add a really good quality company. I never like to put too much emphasis on this, but I know it's a promising piece of supporting documentation. If you look at some institutional buying, at least of their top 5 holders here by assets, we do see 4 out of the 5 have increased positions. They've bought into this over the past quarter, I believe it is. Again, that's more or less just a bonus. That's something that we do like to see. But overall, for $48 per share, you are pulling in the 1.25% dividend. I really like the stock Brookfield Asset Management at the moment. It'll be one of my major purchases over this year and the next. Again, the price target based on Morningstar represents a 15% discount at $57. On to the next stock, which as well as a Canadian one, but this stock is very different in the sense that it's much smaller. It's a lot more exciting. It is the company Aritzia, ticker ATZ.TO. And when I say smaller, I mean, we're looking today at a $2.5 billion market cap versus a multi-billion dollar. I think BAM is a $73 billion. We're looking at 2.58 today. Aritzia is a stock that I did do a video on a while back. If you do want to go check that out, that will be a more thorough analysis, as that entire video was pretty much dedicated to Aritzia. However, we did make the comparison asking, is it the next Lululemon? Does it have that type of potential? In a sense, there's a lot of similarities. They're both based here out of Vancouver. They do have locations now. They have over 95 locations across US and Canada. This is, of course, the women's clothing company, by the way. They like to classify their, based on this tier list, I guess you could call it, their style is considered everyday luxury. And they have 12 exclusive brands under the belt, ranging from Babaton, Wilfred, TNA, just a few that you may be familiar with. But a couple of reasons as to why I like Aritzia as a company and why I think there's actually really good potential for the stock going forward, even though it's a retail play, which a lot of people will argue for and against. For one, they have done a very good job in the industry and actually across a lot of companies, in my opinion, with building up and leveraging and kind of leaning on their e-commerce platform. During COVID, as a fun fact, e-commerce revenues increased by 82% during the second quarter. So as a lot of stores were closed down, as people couldn't go out and shop as much as they usually would, that didn't seem to be much of a problem, as a lot of them just kind of shifted to going online. From everything I've heard, it's a very enjoyable process of shopping online, and I know that a lot of people out there do it. In fact, I think a lot of people would actually prefer the online shopping nowadays. Anywho, it's good to see those types of numbers that support that. I mean, even if we were to go through another lockdown, for example, the company can still make sales. People will still be out buying the newest, hottest clothes as the seasons change, which really leads into my second point, another thing that I really like with this company. And if anybody has thoughts on this, either agrees or disagrees, you can feel free to let me know down below. I think that Aritzia does a very good job of really commanding. They have a strong command on the space, on the audience, on the niche, or on the market. I don't want to say that they have, like, they influence brands and styles, because again, I don't follow it like super closely or anything, but it seems to me like this company does an amazing job at really hitting the nail on the head with the styles, being current with the times, and really just being a trendsetter. Like, it's just a company that people desire to shop at. It's a store that people really look up to, and that's not just current day. One of the charts that I think is super powerful with Aritzia, which more or less supports my thought process, this chart dates back to 2008 and shows the net revenue growth of the company. So obviously this goes back before they IPO'd, because this stock only IPO'd a few years ago in 2016. But going back to 2008, the company has grown revenues at 16.7%. So a very strong track record, years and years and years of proving that they're not just a fad, they're not just a type of company that falls in and out of fashion. Like, they have done a good job of staying relevant, staying on top. And again, I'd love to hear thoughts down below if you have opinions on this, if you agree or disagree. But that's just more or less something that we like to look for, is that ongoing demand for a company. For whatever reason, they have that knack. Like a Lululemon, there's just something special about them, which, again, I'll say this is obviously a higher risk stock than usual, being a smaller cap company. It trades for $23, but I think it's one that, if you're looking for growth, could really pay off. My girlfriend actually bought shares right after the COVID dip, and they've done extremely well in her portfolio. It's been one of the best performers since. But the shares trade today for $23, and that is the company Aritzia. Jumping back over to the US market for our next stock, this one is very likely my favorite purchase at the moment. It's a stock that I've been buying. It's a stock that I'm really liking. It's the company Raytheon Technologies. Ticker is RTX. This is a stock that is currently down over 30%. It does pay a dividend of 2.8. I believe it's actually a little bit closer to 3. But FYI, Morningstar does have a price target on this company up at 77. This represents about a 14% discount. Raytheon is the company that I know our subscribers have probably heard me talk about. It feels like a million times, and I apologize if you're hearing the same thing over and over again. But very briefly, this company is involved in aerospace. They make big engines of planes. This company was actually previously, before United Technologies split up, before they spun off Carrier and Otis, the elevator company and the HVAC company, which by the way are doing very, very well right now. Anywho, what was left over was the aerospace component of this company. They make, through Pratt & Whitney, like big engines for planes. There's Collins Aerospace. They merged with a company called Raytheon, which makes literal missiles, products that would be used by the military, by the army, the defense segment, let's call it. Pretty much the aerospace side of things, just FYI to kind of give a recap on how things are going. I mean, I think it's kind of common knowledge at this point, but commercial airlines has been a really, really tough industry. Actually, if you look at competitors such as Boeing, they're down substantially. GE's down. Obviously, the airline carriers are all down across the board. What I do like, however, about Raytheon Technologies is that if you look at how the company's constructed, they are not solely reliant on that area. In fact, it's a pretty even balance that they're getting the support from the defense side of things, which tends to be actually quite non-secular. There's usually quite a constant demand for this side. To actually look at some numbers in particular, just to showcase this, in the previous quarter, like aerospace is down. We know that for a fact, but military sales actually kind of propped the company up in the sense that this segment was up 4%. So it's a great way at showcasing how when a company has diverse segments, when they have two areas, that can really help with propping up the company overall, and it can really help them weather these storms. I don't think that the commercial airline area is going to be struggling forever. In fact, if you want to look at it with a hopeful side of light, the Pfizer news with their vaccine, I believe they're on stage 3 trials, 90% effective if you haven't got COVID before. We're getting closer and closer to that, whenever that is, and that could show promising signs for the economy reopening back up, more travel, more airline flights, which again will help prop up one side of this business. Raytheon Technology at the moment really reminds me closely of Activision Blizzard. To kind of tie these stocks in together and wrap this back up to the first stock that we talked about, a year ago, the companies were in very similar positions with a very steep sell-off when the prospects weren't looking so good. And clearly Activision Blizzard is a great example of how sometimes that can be a little bit of a exaggeration. Sometimes the market can actually overreact a little more than it should, which then represents good opportunities for us as investors. With a company like Raytheon Technologies, again, the shares are down over 30%. It's really one that's piquing my interest right now. This stock historically is known to be one hell of a dividend payer. Looking back at this history, dating back to 1970, we see consistent payments of dividends. We see 27 years of growth. This obviously dates back to the United Technologies days, but this is a very high quality dividend paying stock. The institutional buying numbers do look quite promising with this as well. Within 2020 Q3, a lot of additions to the stock. It seems like I'm hopefully not the only one seeing value here, because I've personally been loading up on some RTX at the moment. Like I said, this is probably my favorite pick of the bunch. Today the shares trade at $66 USD. Again, they pay the dividend of about 3%, just a little bit shy, but that is a company, Raytheon Technologies. Now, in moving along to our final stock, we're going to finish it off with Old Reliable. It's another US selection. It does not pay a dividend. It is a company, Berkshire Hathaway. And today we're looking at shares of $341,000. You may want to look into some fractional shares, which we don't have here in Canada, but if you want to get your hands on this for most, I'm just joking, obviously. They do have their B class shares. So the 341,000 is the Berkshire A shares. The B class shares today trade at $227. They actually have a price target on them at $253, representing about a 10% discount. This is the investment company that is, of course, run by Warren Buffett himself, as well as the man Charlie Munger. They own companies. There's been some historic companies over the years, but some of the notable ones would be Coca-Cola, American Express, Apple obviously is their largest position as of today, Bank of America, and Kraft Heinz. I'm really just naming a few. This company to me is really old, reliable. If anybody said that they own this stock in their portfolio or they're thinking about owning shares in Berkshire, it'd be very hard to argue against. They have such a strong track record of producing gains and producing results for their shareholders. A couple pieces of notable news regarding the company that you may or may not have heard about. They recently did a buyback for, I believe, $9 billion. I read that this was the largest buyback in company history. This is a bit of a fascinating one if you know Buffett's history. Essentially, what this tells us, if we were to look into that deeper, is that Berkshire Hathaway has a crap ton of cash, and they really are sitting on a lot of cash. I don't know the exact number, but I'll pop it up on the screen. Rather than going out and acquiring other companies, rather than bumping up their stakes in other businesses, just kind of looking at the broader scope of investments out there, they chose to buy back shares of their own company. That is a bit telling to me. It does give us a little bit of insight into how the management team there is viewing the rest of the stock market in terms of valuation. What it does show as a promising sign is that they're okay buying back shares at this price. Again, Morningstar does feel the company is about 10%, trading at a 10% discount. It's very hard to bet against Buffett, in my opinion, and it's very hard to bet against a company that's sitting on so much cash that they could probably buy out a bunch of other stocks on the market. Very safe, very, very reliable stock. They don't pay a dividend, which I know I've gotten questions on. To put it simply, the company the company would rather retain the earnings themselves. They'd rather keep that cash within the business so that they can go allocate it where they see fit. They've historically done a very good job of finding good investments, and they feel they could actually get a better return there rather than kicking some money out to the shareholders. So that's just one thing to keep in mind. You're not going to get a dividend with this stock, but hey, the share price historically has done quite well, and I'd expect it to do so going forward. Shares trade today for $277, and that is the company Berkshire, ticker BRK.B for the Class B shares. But guys, that right there wraps up our video with 5 stocks to own for 2020 and 2021. If you enjoyed today's video and if you learned something new, if you appreciated the picks, drop a big thumbs up on this video. This one took a lot of preparation. I hope that you guys were able to see that there's a lot of variety within these, in the sense that you have your growth picks, you have a dividend pick, you have your Canadians, you have all sorts of companies. And I feel like this video just should have pleased everybody, because there must be at least one company on this video that you like. Let me know down in the comment section below what you thought of this video, what you thought of my picks. If you're not already subscribed to the channel, you should definitely consider hitting that subscribe button as well as the bell for notifications, because we post videos like this every single week. We do also have our Investing Academy, so if you want to learn more about the stock market, maybe you're just starting out, you don't feel you have a good grasp, click the first link down below. You can learn more about joining our community. We take Canadians from start to finish. All video training. You can ask questions, become part of our community. That's that first link down below. But as always, I thank you guys for watching. I hope you enjoyed, and I'll see you in the next video.